Joining us right now from the CME Group, Rich Ilczyszyn of Lind-Waldock. He focuses mainly on oil and energy. Also back with us, John O'Donohue of Cowen Co. John says the markets are back in his trading range again, as he said before, with 1025 on the low end of the S&P, 1125 on the top end. And John, I want to kick it off with you. Earlier guests talked about potentially, trading in a range. I've heard a lot of people talk about trading in a range. Is that what you anticipate we'll see maybe over the next 6 to 12 months?
It is, actually. I went back and looked at some data from the late 80s, which many of you wouldn't remember, but from 89 through 91, and the correlation with that time period is the S&L bust, housing bust, a lot of other things that were similar, and some that are dissimilar at the moment. But the Dow Jones Industrial Average, because that was the only thing around in those days, moved in basically a 10 to 15% range for about 2 years. Now, that's not very good for my business, obviously, and I heard you referencing that earlier, but there's the potential that we could stick here stuck in the mud for a while.
Yeah, you're still not concerned, though, I assume, about a double dip here, because last time, or at least in June when you were on with us, John, you said you acknowledged that we were sort of slowing down a little, but you didn't think we would go negative.
Yeah, I'm still of that opinion, Matt. I think that obviously there's enough slack in the economy right now that there's plenty of room, if demand does pick up, that it can be fulfilled. But from the standpoint of where we are, I think there's enough protection in place, if you will, from the Fed that I don't think things will get to that stage. So I'm not looking for a double dip. No.
Rich, what do you think? Weigh in on this, if you will.
I don't think we're going to get a double dip. In fact, yesterday coming into trade, I was pretty darn bearish. Market sells off. Everybody getting excited, selling off pretty well. And then today we open up on the lows and rally straight up into the close. Although on light volume, I'm a technical guy. The chart is actually kind of at a turning point. I agree with your last guess. We may chop around a bit, but today was pretty interesting to me. I looked for lower lows and getting some follow through. That didn't happen. So actually today, the way it's closing, we may have higher trade tomorrow. I still think there's big resistance at the 200-day moving average in the S&P. If we get above that with any volume, retest June's high. June 21st, I think, was the high at 1130 in the S&P. We get out above that, perhaps we trade higher. I agree. We're in a range from 1,000 to 1,200.
Let's bring back Rich Ilczyszyn and John O'Donohue. And let me ask you, John, I get an email here from a guy who kind of represents what we're hearing so much on this show recently. Mike Massar writes in and says the Fed sees the mortgage morass on the horizon. The market is overvalued by 20%. And I'm not sure if he's talking about the housing market or the stock market there, but the economy is still rebalancing, and we're only a fourth of the way into the mortgage defaults. We still have a long way to go on foreclosures. I'm sure you'd acknowledge as well. And Gary Schilling tells us all the time that housing prices still have to go down 20%. Doesn't that concern you, as it's what got us into this whole mess in the first place?
Sure it does. And I think, if you looked at what the behavior was that drove spending and hence the velocity of money, was that houses were used as an ATM. From the standpoint of, I think that data is interesting, but what I would also look at is from the standpoint of foreclosures. I think the velocity of foreclosures has slowed down, and I'm not an expert on housing, but I would tend to think that a lot of this sort of the sky is falling. I've heard a lot of that rhetoric for a while, and obviously I've heard some of the ebullient language to the upside too. I think this is a market, to be honest with you, that's going to frustrate both the longs and the shorts. People seem to get on their horse a little bit here a couple of weeks ago when the market was banging its way up through this 1120, 1125 level, and now the sort of the air came out of the balloon. Obviously, the shorts would like to press it to the downside. We'll see if that works too. But I think an awful lot of rhetoric that I've heard both from the Mario Rubinis and then those that think that the market can go to 12, 1300, which would be some of the big wirehouses. I think neither of that's going to take place. I think we're going to muddle around here for a little bit. And obviously, if you look back to that 89, 91 time period, there was an enormous amount of foreclosures. If you remember, we went into the savings and loan issue with the Resolution Trust Corporation, which ultimately worked its way through the system. It took years to do that. I think that's the system that we're going to be in for a while.
Hey, John, it's Julie here. You mentioned earlier you were talking about the Fed, and then it might offer some protection here, but that didn't seem to be the perception of the market earlier this week. Earlier today, I talked to Mike Ferroli, who's an economist over at JP Morgan, and he said the Fed doesn't have bullets left, it has BBs. I mean, isn't that a concern?
Well, yes, I would think so, but I think the Fed is not the be-all and end-all. I mean, if you look at if the rhetoric that we've heard over the last week, especially about the U.S. correlated with Japan in the 90s, I think if you look obviously what happened with the Japanese economy, and it is a very different economy from the standpoint of cross holdings and savings rates, I think the United States may get into that situation, which obviously isn't the best, but again, it's not something that's going to come crashing down around our ears.
Let me bring Rich back in this discussion. Rich, what's the thought on the floor about what the Fed can do for the economy and what the government can do for the economy as far as more government spending? I mean, do you guys want to see more stimulus, or would you want to see a pullback?
I don't want to see any stimulus. I think at this point we need to take our medicine, go through the drawdowns. The big component here, obviously, housing's important. You can't buy a house if you don't have a job. So we have to think about maybe tax cuts to stimulate small business and big business. Let's get some investors, risk takers, entrepreneurs back into the market. I think there will be some good value. I'm not a doom and gloom guy. I still think you buy the dip, look for value, and then ride it up and trade it. Trading range. That's what we were talking about earlier. I don't think it's all about the Fed. It's going to be kind of a combination of things. We're in a slow recovery. That's it.
Hey, Richard, it's Dominic here. You're an oil guy, right? There's a lot of stuff out there telling us that the oil picture is showing the economy is going to be slowing down, not just here, but globally. Things like demand from China, elsewhere in the world. Is the oil company, or is the oil industry, rather, the oil kind of sector telling us something about the economy slowing down here?
Absolutely. As we trade below the 50-day moving average, below 77, 76, and 75, absolutely. I think that oil is going to be poised to trade that $70 to $80 range. That indicates that as we come out of the tail end of the driving season, manufacturing sector is low. You know, who's going to be shipping goods? So we should see a contraction there. That'll be better for the economy, but also some of those oil stocks may come down a bit too and sell off the S&P.
Do we need a little extra something here, be it from the government or the Fed here, to really continue to help the economy out, to kind of get it through this tough spot?
I would hope not. You know, I live in the great state of New Jersey, so we have a lot of our own issues, but we have a new governor that's trying to sort of address some of the issues that we have with the pensions and the medical benefits and the unions and everything else like that. So I think, as the other guest said, we can hopefully, I don't want to say muddle our way through this situation, but I think the stimulus for now is enough. I think discipline has to be put in place as opposed to just sort of, you know, the honeypot that's been out there for some period of time.